Let's have a look at an example of a bearish swing failure. Well, what we can see here is another swing point. Okay, this is a swing point here. Why is this a swing point? Because the market has swung up into this area and it swung away from this area. So it makes a swing high and it swings away. Now again, let's mark out that exact high. Okay, and let's see what the market does when it gets back there. And immediately what we can see is it breaks the high. Okay, so let's draw that in. Breaks the high here, closes below, and immediately the market reverses violently to the downside. Now, I call this the swing failure pattern because basically what's happening is that a swing is failing. The market is failing to take out a prior swing point. Okay, let me just, I'm probably going to have to repeat this next week, but if they've mailed me, they'll have access to it. Okay. Give me 1 second. Sorry about this. That you get with a lot of these, a lot of the sign-ups for these is that they people pay literally about 10 minutes before, and then obviously it's really difficult to add people to the list, and people get left out, and then think I've deliberately left them out. Okay, I'm not gonna stop anymore. We'll carry on now. Sorry about that. Okay, they'll have to get access next week. Okay, so we've looked at an example of a bullish swing failure, and we've looked at an example of a bearish swing failure. Now, let's have a look, okay, at what's actually happening here. Because if you want to get profitable in the market, it's not just enough to actually look and see a pattern. What we want to actually establish is, why is this working? Okay, why is this pattern actually working? Why is the market reversing at these points? And what we're going to do is we're going to look, I'm going to pull up Paint, and we're going to talk about trend. Okay, the very, very basic definition of trend. Okay, so it's on there. It's on there. Paint's on there now. Okay, now the reason why this works so nicely is because people's definition, or traders' definition, standard definition of a trend in the market. Well, let's look at an uptrend. Okay, so if we've got an uptrend in the market, what is the standard definition? Well, it is a high, then a pullback, then a higher high, then a pullback, then another break to a new high. Now, it will look like that. So basically what we've got is we've got a series of higher highs, and we've got a series of higher lows. That's the standard definition of trend. Now, what's one of the first things that you're taught as a trader? Always follow the trend. Don't trade against the trend. The trend's your friend, you know, all the rest of it. Okay? But what you've got to think about is what the traders, when they define trend, and this is the standard textbook definition of trend, I don't know of any other, what does this mean to traders? Okay, well, let's think about it. What it basically means is that if a trader gets, let's say the market starts to turn, and a trader gets bearish this market, and he thinks, I think this is going to go down. I think this is going to tank, and this trend is going to get undone, and it's going to go into a bear market. If he gets short at market, so he decides to just get short around about here, thinking that the market's going to go down, where is the average retail trader going to put their stop? Well, it's going to be above the swing high. Okay, why? Because as soon as it breaks the swing high, they immediately presume that they're wrong. I mean, swing points are one of the most common places for stops to accumulate, without a single doubt. Everybody, nearly every single retail trader tends to put their stops beyond swing points. So if a trader's got short, predicting that the market's going to move down, they're going to use a buy stop above the swing point. Now, it might not be one tick above. For a lot of traders, it actually is. But sometimes they might try and be clever and use 10 ticks, 15 ticks, but it's going to be somewhere close to just above that swing point. Now, let's look at it in another way. That's for the shorts. What about if a trader is bullish the market and they want to get long? Well, as the market moves up and goes through this area, traders are going to think, right, I'm trading with the trend. I'm being clever here. We've got higher lows that have been put in. There's another higher low here. We're breaking to a new high, and I'm going to buy. And they will buy either with a buy stop or they will buy at market. So what does that mean? That means that above swing points, above swing highs, you tend to get a lot of buy stops. Okay? And below swing lows, the exact opposite. You tend to get a lot of sell stops accumulate beneath these areas. Okay? So why do the sell stops accumulate? The exact reverse. If the market heads down here, when it breaks the last major swing point, traders are going to believe that basically the trend is over. And if they're long, they're going to stop out. And to stop out of a long, you sell. But obviously, as it breaks that low and it makes a lower low, traders think, right, the downtrend's coming in now. So they sell as it breaks beneath the swing lows. So the sell stops, or the sell orders, accumulate beneath swing lows, and the buy orders accumulate above swing highs. Now, why does that matter? Why is that important? Well, it's important when you come to think about liquidity. Okay, and I said this in earlier webinars, but you've got to be thinking about liquidity, because a lot of people that trade fairly small size have no idea that the pros have big troubles getting their size away. It's not easy being a professional with a huge amount of size, even in a liquid market like Forex. Okay, for us, it's very simple. You know, we define our units, we position size effectively, we decide where we want to get in, and normally we get filled at the price we want. Sometimes we might get slipped a tick or two, but we usually get in where we want. Now, a professional hasn't got that option, especially in some liquid markets, like some illiquid markets, like stocks or stock indices, but even in Forex too, they have to be able to have a lot of opposing orders to fill their size without pushing the market. Okay, so if a trader wants to sell, if a big trader wants to basically sell up here, and he decides maybe he's done some fundamental analysis, or he thinks this might be potentially a double top and he wants to sell, he is going to need a lot of buyers. Why? Because if he starts slamming the market with size, he's going to push the market down. And other people are going to technically join him, saying, you know, there's a double top up here and there's a big seller and the market's moving down. And they'll join him and he'll get a worse price, because a big trader does not want to sell with other sellers. A big trader wants to sell to vast amounts of buyers. So the big trader has to get the liquidity of buyers. And that is why they will use breakouts above swing points. If they want to get short, they'll be selling above a swing point, because that's where all the buying will occur, from the shorts that have had to puke and from the longs that think the market is going up. Okay? Now, here's where it gets interesting, because some people will say, just close that. Okay. I'm just going to pull something on the screen here. Okay, I'll just wait for the screen to refresh. Okay, good. You can see PowerPoint on the screen now. You should be able to see PowerPoint. You see a white box with some writing in. That's what should be on there. Now, what's interesting about this is some people will say to me, Tom, okay, fine, look, the market breaks these areas. How do you know that traders are really selling now? I mean, seriously, who is going to sell just beneath the swing low when the market has collapsed? Okay, and what I'm about to do is prove to you who is selling beneath swing points and where they're getting bearish the market and why this pattern works so nicely. What I've put on here is a tweet, okay? The reason it looks a bit messy is because I've blacked out who's actually tweeted it. I don't want to get a libel case against me. But these are, you have hand on heart, the people that are trading these are big trading gurus, okay? And I mean big. They're the people that's names are repeatedly on the web. Some of them actually quite well respected names in technical analysis, and they have some of them have trading rooms, etc. But I blanked out the names. Who's saying it's not important? It's not a name and shame tonight. I'm just showing you what they're saying. Okay, look at this here. So this tweet came out on this red candle. Okay, on this red candle here, looking for a test of the 1640 level on gold, which is the lower white line. So far, so good. Lows being attacked. So as it came through that area, they're immediately looking for it to go to the second area. Lows being attacked, all looking good. And what you find is gold breaks the prior low, closes above, and immediately starts a rally up to the first kind of trouble area. So what we're saying here is it doesn't break this low and immediately collapse, as everyone seems to anticipate. No, people sell it as it goes through there, for sure, because they see 4 hours of downward action, and guess what? They see it collapsing into this area. They see a massive red candle. They see a lot of momentum into a prior swing point, and they think, oh, this is going to go. This is going to go now. Where's the target? Yep, down at 1640. And then immediately they sell. As it goes through the low, the market immediately reverses. Now, that's just one. Let's have a look at this, the next example. You'll like this one. Here's the Euro Australian dollar. Okay? This was another tweet that came out. Okay? And what you'll see is, you see this market put in a swing point right around here, and it broke it with this big green candle. Again, for the highs. So what have we got basically here? We've got an uptrend, a classic definition of an uptrend. We've got a high, the market makes a higher high, pulls back, makes a higher low, starts gunning again for the highs. So this tweet comes out from a big name. Uptrend confirmed, long opportunity above 127.45. Look at 127.45 on that chart. I've marked it in yellow. It's not a pip above the swing high. It's a few pips above the swing point. Okay, so as we've gone up into this area, this person is getting bullish. Now, this isn't a swing failure, okay, because it doesn't break that prior high and close back beneath it. All I'm trying to show you here is why the general pattern works. Because look where people are getting bullish. Now, long opportunity above 127.45. That's the yellow line. Okay, above being the key word. You guys are probably thinking, well, yeah, but maybe if it does a rounded retest, no one's going to get long there, right? No one's going to just buy that as it goes through a swing high. Surely not. No one would do that. Let's have a look at the next slide. This is the same person. As with yesterday's trade, we will wait for price action confirmation or a break above today's high before buying into the rally. Specifically, traders should set a buy order at 127.45 above today's high. A stop buy going into the market above today's high. So if we just backtrack, there's stop buys. That is a big named guru suggesting to buy there because it looks bullish. It fundamentally, if you're a technical analyst, the market looks bullish up there. It's broken out of this swing high. It's broken out of a major 2012 high. Everybody's bullish. And then immediately look what happens. The big sellers that need the liquidity of all the buyers sell straight into it and we collapse. I'm so aware of this pattern and I see it happen so often that let me show you something else here. And this is me taking the mick a little bit, but this is essentially what I look for. This was another big name. Some of you probably know who it is, but keep it to yourself, please. This was the euro dollar. Okay, this was the prior swing low where my mouse is hovering around. And again, that was at 130.70. And the person says 130.70 is the key support that needs to break for a test of 130. Okay, and look what I've immediately wrote. If you're selling down there, let me know. I'll make a bid. Because look what happens. As that market comes in here and breaks that low, look what happens. It hardly go. This is an hourly chart. We hardly go 20 pips more before there's a violent reversal. Now again, this is not a swing failure. I'm going to show you plenty of them in a minute and what they look like. I'm just trying to prove to you that this is not all, you know, mumbo jumbo. This is actually real traders thinking, we break that swing low in the euro, it's curtains. We're going to collapse. And so what I'm putting here, although this is a bit of a piss-take tweet, what I'm writing here is basically when they get bearish, we actually need to look to get bullish because the professionals with big size will be. And so what we're going to look for at these major swing points is we're going to look for the break below these areas and the close above. That's our pattern. Now, a couple of points to make here. Let's close that. Go back to the charts. A couple of points to make here is that what we want to actually be looking for, and this is quite important with the swing failures because they're such a great pattern that I think a lot of people are getting very, very carried away with them. It's a bit like when you first discover pin bars. You see a pin bar, and the next thing you know, you're trading every single pin bar on the charts, and and then you don't really have a huge deal of success with it. Look for them. The optimum place to look for them is at major swing points. Now, the major swing points, again, it's time frame specific. It might be a major hourly swing point. It might be a major daily swing point, major 5-minute swing point. But a major swing point to me is defined as a swing point where the market has swung down violently into an area and it's swung away nicely from the area. It's made a nice swing point away from the area and into the area. Therefore, it creates a swing point with space before the market comes back and retests it. So what we're essentially looking for is we're looking for space. Space is, you often hear that saying that space is key when people are trading levels, trading price action, and it's key in this as well. Okay, so when we make the swing point and we come back to it, we're looking for space. So what we've got here is a great example of an hourly trade that was taken on gold. Here's the swing low. The market rallies into it. The market rallies away from it. The market comes back for a test of that swing low. It breaks below, it closes above. This is not any candlestick pattern that you're ever going to get taught. This is not a pin bar. This is nothing. But it's very, very useful information because it has taken the stop sells into the market. Look what's happening on this gold. It makes a high. It makes a low. It makes a lower high. It makes a lower low. It makes a lower high. Again, this is a downtrend. This is a downtrend now. And that's why everyone is selling when it breaks those lows. And that's also why they're going to get their arses handed to them. So the pertinent points to look for this pattern are at the big key swing points, all right? The key swing points where people are going to get wildly bullish or bearish, all right? What's not a key swing point? Well, I would say this one here is not really what I would call a major key swing point. Why not? Because it's not a major high. The market only drops off for 2 bars and then comes straight back to it. If I got a swing failure there, I wouldn't really call that enough of a dip away from it. Yes, there's a little bit of space, but there's not been it's not a deep swing. I guess the best way of describing it is you're looking for quite a deep swing. You're looking for a point where the market has really dropped away and rallied hard back to it. So in this first example, the market's dropped hard. It's rallied quite sizably away. I mean, we've gone from 1711 to 1730. We've had a $20 rally. It's a pretty sizable rally. And that's what you're looking for, the deeper swing points for the traders to get stitched up. Now, have a look again. Up here, this was one of the best opportunities. This was a little period in gold where, I mean, it was literally cleanup territory. Check this out. So the market makes, after stitching everybody up at the lows, it has this gigantic rally, and it breaks all these swing points, and we start thinking to ourselves, this is very interesting. Have we got a potential trend reversal? Well, look, here's the swing point on the upside, and we make a violent move down from here, and then we start coming up again, forcibly, into that area. Big green candle coming in here. Now, what are traders thinking, and they've got their textbook out, they're thinking, if I look at trend, we've made a higher high here, now we've had a pullback, and wait for it, it's a higher low. And now we're going ballistic with a big green candle. This is going to make a higher high. This is a trend reversal. I'm getting long. And in they go with all the stop buy orders here. Now, if you don't believe this happens on a daily basis, get some of the big gurus that you've been probably shunning, thinking they're scammers, and start following them on Twitter. Because you can actually, it's about time to make some money off them. Have a look at the areas they call. Now, look here again. Break above a swing high, close below. Do you want to fade that candle? It looks pretty bearish. It looks pretty bullish. It looks quite scary to fade that candle, to go against it. But again, look at the market. Immediate collapse right off this area. Okay, then the next swing point, which is here, this is the swing low. Note how we close below it that time, so we get no setup here. Okay? Now, look at this. This was the last swing point, the original first trade. What might that be? Does anybody know? Well, that's a candle that a lot of people are going to say is a pin bar. Yes, it is, but it's also another swing failure. Look at this market. Basically, every single way it turns, it's thrusting about violently, and it is stitching everybody up left, right, and center. There's a long just as it breaks these lows. There's a short just as it breaks these highs. And there's another long just as it comes back to these lows. Traders surely thinking at this point it's going to collapse. But no. So one of the key things that you want to be aware of is, yes, there is that standard definition of trend. But you want to think about, when you look at a trend, you want to think about where's the liquidity going to come in? Where are most people going to get bullish on that trend? It's going to be as it makes a new swing high, if it's an uptrend. If it makes a new swing low, it's as it breaks a downtrend. And at those points, that's where you want to look for potential reversals into the market. Because the market, it traps these traders. You know, anyone that got long perhaps this gold and put their stop underneath here, for sure they're going to be stopped out. They've lost money, but they're not trapped. They're stopped out. But the shorts that went in down here are trapped. And when they're trapped, they're going to have to buy back. And when they've got to buy back, they're going to fuel the market higher because they're going to have to pay up frantically to get out. Okay? Again, I mean, we've looked at some hourly setups here. But just, and I think it's a good idea to constantly familiarize yourself with the pattern. But here, look at some of the longer term moves that can be established from swing failures. Here's the reference point. I'll mark it in with an ellipse. There's the swing low. There's the swing failure. There's the massive rally. Look again at the highs in gold, the all-time highs in gold. What do you notice? Some people might say they notice a bearish outside bar. I noticed that. I certainly noticed the swing failure immediately as well. Swing high, huge drop away, huge rally back, break, close below, it's finished. It's game over. So it's not that every single swing failure is going to work, but it's a very, very reliable pattern to look for and to start to trade. And you can, I know some people that are literally are trading this exclusively now. that are looking for this at major swing points and trading it exclusively. But if you're going to do that, you've got to be mindful of the bigger swing points. And like I said, I don't think it matters whether you're finding them on a 5-minute. I know quite a few 5-minute traders that are finding them. But again, make sure it's a deep swing point on a 5-minute. If it's an hourly, make sure it's a deep swing point on an hourly. Now, I'm going to answer that question FXG now because that's quite interesting, and I'll give you some different trade examples now. But let's talk about what I do, how I actually trade these things. Well, the first thing that I want to draw your attention to, and we'll look at this. We'll look at this one in gold. This is a daily chart, but it doesn't really make much difference. What we look at when we're looking at this is we've got to think about where the pattern invalidates, because that's the first idea we're going to get about where we're wrong. And I always want to almost work backwards. A lot of traders immediately start thinking, where could this go? How much profit might I make? And I'm always thinking, what if I'm wrong here? You know, how much could I lose? Because you've got to protect your capital first and foremost if you want to do this for a living. So, you know, because if you've got no capital, you can't make anything. So it's absolutely key to keep your losses tight. So we need to know where we're wrong on this pattern. Well, once the pattern forms, the point at which we are wrong is not, as you might think, when we break the low. If we put in this swing failure and we traded this long, I found in my experience that it can often come down and re-break the low again before taking off. So when I first discovered the pattern, my initial feeling was, well, we enter on that kind of swing failure candle, we put a stop below the low, almost like you trade a pin bar. But then I started seeing that it would, like I say, it would often come down for a second quick little nab of the lows one more time and then go ballistic. It hasn't in this example, but it often does. So what I started realizing is that really on this pattern, you're only really wrong when it closes below that low, below the actual bar that you trade. Okay, now I don't mean close the day, I mean close on the time frame that you look at. So if you trade it on a daily chart, you'd only be wrong on that pattern when you get a daily close beneath that low. If you trade it on an hourly pair, hourly time frame, then it would be an hourly close beneath that point. So what I started doing when I started trading these is I started basically trading them entry on the first off the entry. The entry's taken on the close of the bar. Okay, it's not when it breaks the highs of the bar. You don't have to worry about any of that. You know, you don't need any more confirmation. You don't have to start, you know, putting in, you know, paying up and getting in when it breaks above the bar high. The entry, the best entry for these, in my experience, is entering on the bar close. Okay, as soon as that bar closes and you know it's a swing failure, you enter on the close of the bar. Now, the stop is where it gets tricky because, like I say, my initial feelings when I started trading this was that really I shouldn't have a stop and until we close, and then as soon as it closes beneath that low, I will get out of the market. But what I've actually noticed is that, you know, two things. Occasionally, if you don't have a stop, and obviously the bigger the time frame, the more dangerous it is because you're spending longer in the market without a stop. But there's two things anyway. One, if you don't have a stop, it's not very comfortable for you. Two, you can't position size effectively because you don't know how far the market might go against you. And three, obviously, occasionally, if there is some news or some calamitous event happens, it could really, that low could get absolutely smashed and you might take a big loss. So it's a difficult one. What do? We don't want to stop out till it closes below the low, but you know, but we don't know exactly where our stop needs to go. Well, I started playing with a lot of different things, and what I found out was the most effective was using an ATR-based stop beneath the swing point. So on a bullish swing failure, I use an ATR-based stop. Now, I'll show you exactly what I mean by this. Let's look at another example. It will help if I actually find something. It's maybe on the hourly time frame, because I do tend to trade on the hourly time frame. So here's a good example. This is the Australian dollar here. Now this was an absolutely beautiful trade, and this was basically from Thursday last week. I always try and choose recent examples because obviously You know, we want to see stuff that's been happening a couple of days ago or last week. There's no point pulling up examples from 10 years ago. So what we're looking at here is we're seeing the market has basically put in a swing low here. Okay, let's mark that off. The market has rallied violently away from that area, come all the way back, taken that low out, okay, and it's taken it out by 2 pips. A lot of people say, well, that means nothing. Well, look at it for yourself. If you think a 2-pip break means nothing, you want to look at the pattern. I found it makes no difference, like I say. So what I find here is that the entry on this particular trade is going to go on the close of that bar. Now, my stop, what I do is I apply a 24-period ATR. Why 24 periods? Because Forex is a 24-hour market, and there's 24 hours in a day. So what I'm looking at is the average volatility over an hour, i.e. what on average does this move per hour. Now that 24 period ATR, let me just move to the data window. When we hover over the entry candle, it's going to give us a figure in the indicator window, top left. And that figure is 18. So what I do is I simply mark the low of that candle, which is 104.20, and I subtract 18 from it. So my stop's going to be at 104.02. Okay, now let me make one thing clear. That is what I call an uncle point stop. What I mean by uncle point stop is you don't want to get stopped out down there unless the market, it's a safety stop. We only want to get stopped out on there if the market completely collapses to it. If we get a close through that low, I will be out, even if I'm not stopped out. So this low, if we get a close through that swing failure low, then I'm out. Now, it's that low that I'm concerned about. I'm not worried about the previous low because we've broken it if we're trading a correct swing failure. So it's the first low that we make on a close below that area, I'm out, even if my stop hasn't been hit. But the stop is there for safety, and so I can position size. Now, where's the target going to go? The target for me, and this is not specific to swing failures, it's specific to everything I do. The target is specific to the time frame I'm trading on. If I'm trading an hourly chart of the Australian dollar, and I've got, my question is, do I know where it's going on the daily? Have I got any major daily bias? I'm not going to go into that too much now because that's stuff for future webinars, and some of you are already very familiar with that. But if I don't know where it's going on the day, i.e. if I've got nothing to make me bullish on the daily time frame, like a big daily pin bar or a daily bullish outside bar, I'm not going to get long and hold it. I'm looking for a quick trade. Now, where is that going to go? Where am I going to take profits? I'm going to take profits at the FTA all the time. And the FTA is going to be here. It's going to be bar highs, bar lows. So that essentially is going to be a pretty quick trade. We're going to be entering on the close at 38s with a stop at 02s. We've got a 36 pip stop. And we're going to be targeting 66s, this low. So we've got about a 28 pip target, 32 pip stop, just under a 1-to-1. Now, here's something else that's a little bit interesting. When you see this kind of bar, in fact, let me show you something else and make things a little bit clearer here. Show you a trade that I did recently in cable. Okay, this was a trade I did recently in cable, and I called this trade out on Twitter. I went long cable here, and the reason I went long cable is because, again, look what's happened. We had a swing down, we had a decent swing away, we came back to that area, broke the low, closed above. It was quite a nice little swing point. Note what's also effective about this is there's SR there. previous highs, previous lows. It's a level, basically, isn't it? And guess what? If you tried to be clever and bought that level, and this is stuff I teach, you know, it breaks out of this level and it comes back for the rounded retest, and you get long and it starts moving into profit. Where's your stop going to go? Probably beneath those lows. So you've just been shaken. What's one of the most common things that you hear retail traders say? Oh, I got stopped out, I got shaken out. Well, this is usually why. Stops go up, underneath that low, out they come. Now, I traded this cable, and my target on this was a break to these highs up here. And in fact, we'll get onto this in a second. But what I was going to say is this, although it's a great trade, this is a trade that a lot of people feel comfortable taking. Why? Because it's a pin bar. Okay? But what you've got to think about is that actually, you don't really want a long wick on your swing failures. You want a fairly small wick. You just want it basically to break that low and close a little way above the level. Why? Because we're basically saying that we're not wrong until it closed beneath the lows. So the bigger that wick, the bigger your stop's going to be. So when this occurred, I thought it was a great setup. I mean, I had to get long off this. But basically, when I took this, I was it was so funny because when I tweeted this, everyone was saying, oh, you know, you've got a pin bar. That looks great. You've got a pin bar. And I swear to you, when this was forming, I was praying that that wasn't going to end as a pin. I was literally sitting here thinking, don't end as a pin. Please don't end as a pin. Because I just wanted it to end lower, so I've got a tighter stop. You know, I know it's I know that it's going to have got a very high chance of rallying. I just don't want to pay up here. You know, so I just want it to close literally, you know, 5-10 ticks above that low there, and it's fine. But it did close the pin, and I got long. Then, interestingly enough, we got I don't know if this was a swing failure up here. No, it wasn't. It was a double top, perfect double top. So, what you're looking at here is basically, yeah, just a trade again, got long, and it on the close of that bar, although I didn't want to, but I ended up paying up for it. Took profits at the highs, stop 24 period, volatility stop beneath that low. Okay, so let's go over the volatility period stop again. It's 24 period. Easiest way to work it out is just go to view and data window, and it will give you the period here. So if you touch the candle that you want, it will tell you what the ATR is for that candle. So it's on that particular candle, the ATR is 18. So we're going to go 18 beneath that low. That low is 57.99. So you're going to go at 81s with a stop, which is going to put your stop there. Okay. Now you can see what immediately you should be able to probably see why I didn't actually like that trade too much. I'm paying up at 37s, and I've got my stop at 81s. Right, so I've got a 55 tick stop. Now, if I get long at 37s, my target is still double O's. So I've still got a 63 tick target, 55 tick stop. I've still got basically over a 1-to-1. But the less you pay up, obviously, the better, especially when you're on a decent size. And I remember one of the big traders. This always seemed a bit of a paradox to me, but it's quite useful to think about when you come to swing failures. I was in prop trading. For those of you that don't know, I used to be a professional futures trader for a firm, and I made the transition to working from home. But we used to have questions and answers with the bigger traders, the guys that were really making huge amounts of money, like 100, 200 grand a week traders. And occasionally they were brought in to give us 5 minutes of their wisdom, and we could ask them questions. And one of these guys was a very, very big trader, and one of the questions he got asked was, can you give us one thing that can help us as a trader, to learn one thing? And this guy was making a couple of $100 grand a week, and he said, I got one bit of wisdom for you. Okay, a big difference to your trading. Enter the market as close as possible to where you are wrong. Write that down if you don't understand it. It's something to think about. but enter the market as close as possible to where you're wrong, i.e. keep your losses small. You want to look at the market and you want to decide, and that's why I don't trade pin bars anymore. You know, for those of you that are following my threads, that's why when I see an excellent level, I buy it. I bid or offer it at the level. I don't wait for a 100-tick pin bar to form and then go and, you know, and buy it after it's gone parabolic off that area. I want in at the source. Why? Because if I get in at what I perceive to be the turning point, if that level doesn't hold, it's very close to where I feel wrong. The level doesn't hold, I get out. But if you trade a pin bar, you're buying it, like if you buy this pin bar up here on a normal trade, forget the fact it's a swing failure, but if you buy that up there, you're buying it so far away from where you liked the level that basically it's got to come all the way down here and then break those lows before you feel that you're wrong. So, as Adrian's saying, the point of lowest risk and greatest reward, in a nutshell. But you know what? Traders tend to do a lot of backward stuff. They tend to say, I mean, you wouldn't believe this. Some of you probably laugh now, but you wouldn't believe what I see people come out with. But I see sometimes people buy something like this pin, and I'm going off on a bit of a tangent now, but they'll buy this, and they'll say, well, I want my stop under here, down, you know, underneath the pin, and I've really, you know, I know I should be getting about a 3R. It's all about risk reward. I should be getting 3 times what I risk. So what's 3 times that risk? Oh, that's up, you know, that's all the way up here. So that's going to be my target. Like the market knows where your risk reward is. So what you want, you don't actually want this kind of candle in an ideal world. If the setup's good enough, you can pay up for it, but you don't really want it. You want something smaller. Now let me give you a better example here, and this will give you an idea of what we think about with bias as well. If you look at this pattern here of this dollar Canadian, if you look at the swing failure here, okay, this was quite a nice little trade. What you can see is that we break this low and we close above. I'm just about to show you. If you see here, we break this low and we close above. So at that point, we know that we've got a daily bias that this is going to head up, that we're going to get a reversal at this point here. Now, if we're going to choose which we think the market may go to, in a very short term, you'd be probably anticipating, we don't know what comes next, you'd probably be anticipating these bar lows to hold some kind of strength in the market if the market rallies up into that area. Now, when I get a daily swing failure, I'm going to use that as bias. What I'm going to do is I'm going to come down to the hourly to find my entry. Okay. Now, looking at this trade, where do we know we're wrong? Well, we know we're wrong if we get a close beneath these lows, right? But if we enter it on a daily time frame perspective, we're entering it at 98.97, which is the close, and the lows are all the way down at 43s. So we've already got, you know, 55 tick stop before it even breaks the lows, and we're still not wrong until it closes below. Now, what I want to show you is what happened on the hourly time frame on that day. So we're bullish on that day, looking for a long setup on a lower time frame. Let me show you the hourly. Okay, and it was here. Okay, market makes a low, market rallies away from that low, market comes back to the low. What is the low? It's there. Market breaks it and closes above. That's what I call being as close as possible to where you're wrong. You're trading a daily bias and you're entering at 98.49, basically 8 pips above the perceived low, with your target being all the way up here. So you're trading an hourly swing failure into a daily swing failure, but you're trading that with a really, even with a 24 period ATR, you're trading that with a very tight stop. Why? Because look how close it closes to the low. You see, you don't want the big wicks. as Zing is saying, you don't want these big swinging dicks. You know, you want basically it to close right near the lows, but just to have not to have closed beneath the lows. And so, like I say, it's liquidity again. So I think it pays to always think about where you are in the great scheme of things, because if you see a daily swing failure, what I will tend to immediately do is come down to the hourly to get in. Now, I might get in on a break and retest of a level. I might get in on another swing failure intraday. But I tend to want to get in on the hourly because, for me, I don't like the big stops that a daily time frame is going to present to myself. So if you're just looking at an hourly chart, you want to often flip and look at the daily charts and see where we are in the perspective, in the great perspective. Because, like I say, if you get you don't need many trades like that to do very well in this market. You know, let's just have a look for reference what the ATR was at this particular time. And I know, again, some of you might be a little bit confused, but just hover over the candle. The ATR is 16 pips, 24 period, 16 pips. So our stop would go 16 below 41s, which is what, 25s? My maths is not great, but 25s. Okay, so you enter on the close, which is 49s. You pay your spread, give it a couple of ticks, you get in at 51s with a stop at 25s. You've got a 26 tick stop, and your target is basically all the way up here because it's a daily time frame target. So you're looking at a 75 tick target with a 25 tick stop or a 3-to-1. Now, I don't get 3-to-1s a lot of the time. My average risk reward is just over 1. It's about 1.2, but I've got quite a high strike rate. But a 3-to-1 trade is obviously fantastic when it comes along. But you're not, you know, that risk reward is not imposed by the market. It's imposed by where you get in. And there's probably a few of you thinking, well, yeah, duh, I knew that. But a lot of people don't. I mean, you see people make those mistakes all the time. One of the most common things I see is people not getting out of the market because they haven't made their risk reward, which is also the most ludicrous thing I've probably ever seen. So, I mean, I do tend to vary my size a little bit within a kind of ceiling of aggression. So, yes, I do that thing. I mean, if I've got an hourly bias into a daily bias, I tend to think, right, brilliant. It's more confirmation. So I will up my risk a little bit, but I tend to have a ceiling. So it will be something like, for example, 3% for an absolute grade A setup. And I'd go to 3% for a setup like this. Maybe if it's just a single hourly swing failure, I might stick it back to 2%. You know, I do tend to vary a little bit, but not drastically. Otherwise, that can affect your bottom line. But vary a little bit, and I do tend to be a bit more aggressive on these better setups. So where you've got this confirmation. Here was a trade from Friday. Some of you might know I opened the room up Thursday night just to alert people to what was going on here. And I don't know how many of you took this, but this was an absolute no-brainer. And I'll show you why I'm mentioning it on a swing failure webinar in a second. But look at, I mean, this is all it's really about. Massive level, multiple support. Note here, first off, I missed this, but that's a swing failure in the SPOOs. So everyone's harping on about the SPOOs being in a massive uptrend. Market pulls back, shakes out some of the weak hands, immediately goes vertical. Now, I missed that, like I say, but it comes back down and it breaks my level and it closes below. I got short, I sold 393 3/4 and got that big drop. And this was the funny thing, is that when I got that and I closed that trade out, and we closed it out just ahead of these lows, I said to everyone, right, it's been a good week. I'm going, you know, I'm finished. I'm done for the week now. Have a good weekend, everyone. And then miss this. Look at this. I mean, again, look at what happened to the S&P. Nice swing up. So it's had a decent swing down. Nice swing up. We traded this short. Then it breaks the prior lows, closes above, again with the pin bar. Not ideal, but it's the same pattern. And immediately straight up to that level again. Now, one thing that you can think about there is if you were short that SPOOs and you didn't get out where I did, we could use this as an exit pattern. You know, there's no point staying short the market if you know a rally's coming. You might as well get out and resell it higher up. So again, it's not always just to be seen as black and white as, oh, when I see that pattern, I'll get long or short. You can use it for management. And it's quite a good tool for management. You know, if you put a target in, let's say I mean, I know a few people that were trading the SPOOs with this as a target, all the way down here, prior highs and a low, so it's a flip point. So if you're short up here and you're heading for it to go down there, you don't want to hang around after that swing failure bar. You want to think to yourself, that is probably going to reverse and I'm going to get squeezed on my short, especially coming into Friday afternoon like that. So, like I say, you can use it as a management tool as well. But I mean, again, I wouldn't have really liked to pay up on that. I don't like these pin bars at all. I wouldn't have liked to have paid up on that. But it's just worth noticing that it's the pattern again. I'll give you a more example of the ones that I prefer. Let's have a look. And again, what I mean by these tight stops. Okay, this was a let's move that. This was a beauty in the April crude. Look how tight your stop is for a volatile market like crude. Zoom in a little bit so you can see that. You're basically buying it. It's perfect. And there's no need to be scared. You get a bearish outside bar. You get a really, you know, it's broken all the support lows. People are getting so nervous here. They don't want to sell this. And that's probably what makes it the best trade out there. There's a lack of people. Sorry, people don't want to buy it. And that's what makes it so good. It's always the hard trades to take that are often the best. So you're looking at getting in here on this setup, and look what happens immediately, just a violent rally. And the funny thing was about this trade is, for those of you that know it, this was actually news based, because what happened here is the US came out and said they were going to ask the UK to release release oil from the strategic reserves, and then literally it collapsed down to this area, formed a swing failure bar, and traders like in my trading room were getting long, and then suddenly the next minute they went, wait, hang on a minute, that's just a rumor, no one's releasing anything, and it went absolutely ballistic. And obviously people come back afterwards and go, well, you know, the fact that works, nothing to do with the candlestick pattern, that's just the fact that it was a piece of news that wasn't true, and you got the move back. But essentially, why did it have to break that low? Why couldn't it have double bottomed at that low or stop just above it? It always seems to have to break these areas before it can do anything. And so I do find that, like I say, pretty fascinating. And not every single time is this setup going to work. But here's another one. Let's have a look. Here's another example of it here. In fact, this is quite interesting, because it will illustrate something that I know. If you look at this is technically a swing failure. Okay, it breaks that swing point there, closes above, market. I wouldn't call that an optimum trade. Going back to what we were talking about earlier, and going back to the sort of the beginning of looking at the really pertinent swing points, I would say that this is not enough of a swing down that was created here. I do really have a thing for the bigger swing points, because this pattern seems to be a lot more reliable at the bigger swing points. This just looks like some sideways congestion, not a massive dip down into this level, and therefore I wouldn't take that long. I know it worked beautifully, but I wouldn't take it long. Now, I would have been all over this, again, if the wick hadn't been so big. Look at that. I mean, you can't get much nicer than that for a failure bar. Again, that was news-based as well. Let's just have a quick look, Hugh. Okay, so on that candle, the ATR was 48 ticks. So 48 ticks beneath 105.27s is 104.79. And that low is 83, so no, it wouldn't have taken you out. And that's why I like that ATR based stop, because it's very, I mean, I've back tested it, and it's very reliable. So it tends to keep you in the market if the market tries to re-stitch up the lows. But like I say, I mean, I'm going to pass every time on a trade like this because I'm just not paying down here. No matter how good the setup looks, I just don't want to pay down and get in here on that setup. But again, coming back to trading and how the things that people most think about, or the retail that's most pertinent in the retail traders' heads, is stuff that generally the professionals do the opposite of. You know, so market breaks a swing high, retail get bullish, pros sell into them. And market makes a huge pin bar, retail love it. They go, oh, it's pin bar, you know, it's a great reversal candle. But really you want to be looking at that and thinking, shit, it's a pin bar, and I don't want a pin bar there. You know, I want that closing just beneath those lows. So again, it kind of, as I say, this is what we generally look for. And what I do is on all my charts, I will go over and I will be aware of, on every single market, where the major swing highs and the swing lows are. So literally on a daily chart, whether it's, say, take the Aussie dollar here, I'll go over and I'll think, right, where are the bigger swing points on the time frames that I trade, which are the hourly and the daily? And I'll mark them out. And like I say, I want ideally the bigger swing points. So like, for example, on this Aussie dollar, as it's been moving down, the biggest swing point that I'm really interested in on a daily basis is going to be this here. You know, and why that there, just take this off, why that there? Because I don't consider from a daily chart, although they look great on the hourlies, these aren't big enough dips. But this is a big dip. You see, so I like that as a swing low. The last prior swing high, probably going to be this. Which is in and of itself a long way above market. But then you can come down to the hourlies and do the same thing. And that obviously brings you more trades, because you start looking at this and you start seeing that we've got a swing point here and we've got a swing point there, and gradually you're closing in on price. So a couple of things, a couple of questions coming up here. We'll go into Q&A session now. Now, I will trade swing failures at a single swing high or swing low if I see it. If I think it's quite a key swing point on the chart, I will trade it. I do often like the market to be past its ATR as well, and I use the 24 period ATR, and I do quite like the market to be past its ATR if I'm trading a single swing point, although it doesn't have to be. But if it's come back to an area, so it's come back to a kind of key area, and it's basically SFPing at a level, then I would be happy with that. So to answer your question, Matt, if it's a second time back to an established SR level, then I will trade that. I mean, should try and show you an actual example on the charts. Here's one. Okay. Again, this was a trade that I know a few people took. Here's some highs. Okay, some lovely highs. Market moves up, pulls back, moves up again, comes back. Now, this is the blind touch entry that I teach in the thread. There's your blind touch entry into those bar highs. The market kicks off, and it has a rally, not a sizable rally, but it does have a rally. Then it comes back. There's the SFP. See, what it does is it swing fails that low. Now, you can be a little bit more, if it's only a single swing point, okay, i.e. the swing point is not a level. If it's only a single swing point, you want to be a bit more careful with them, and you want to just choose the biggest swings. If it's a great level like this, it's not so important that we've had such a violent swing. Again, look what happens here, how we get the swing failure, and the market comes down and it nabs it again, but your volatility-based stop doesn't knock you out. If you've got a stop below that candle low, you're out. But if you use that volatility-based stop, you stay in. Let me show you another something else that's interesting here. I know a few people that traded this. Okay, that is not a great trade. Why is that not a great trade? Because again, you want to be thinking where traders are going to get bullish. Okay, where are all these analysts going to get bullish? They don't want to get bullish at that single swing point. Not when you've got this major swing point just above it. So you don't blindly trade every single swing point, but you've got to look at that chart and think, well, it's the extreme high there that's going to get them in, or going to get them bullish. So if you've got a kind of an extreme swing and then a bit of an interim swing, especially when this whole area is more like congestion, you want it really to take out the absolute high. Now, Rose asking quite an interesting question. A single swing point is more important than major SR. I like single swing points. I also like points like this Aussie dollar that's maybe the second time back to a good level. I don't like to trade SFPs or swing failures when they occur at multiple swing points on a level. So let me show you what I mean by that. Let's say you get this occur. Okay, you get a high, the market pulls back, and then you kind of get a high maybe just around that area, market pulls back, then you kind of get slightly higher high, maybe it actually closes above that area, market pulls back, and then it moves into this area, market pulls back, then it comes up here and SFPs that finally. I don't like to trade that because my theory, I don't like to go against levels that have been hit too many times. You know, if we're up here for coming up for the fifth time, I'm not really interested in it, because to me, if the market keeps hammering an area, usually it's a sign that it wants to go through. But it is, I mean, it's a very discretionary pattern. So there may be times that it actually looks nice, but generally, for newer traders to this pattern, I would say if it's hit that area multiple times, I would be very, very careful. You know, I'd stick with your single swing points and maybe points that have been hit a couple of times. Now, Hunter, I don't have a minimum number of bars between the swing failure and the previous swing, but like I say, what I really want is space, and you kind of. It is very discretionary, but the chart has to kind of look right. Like it has to look like it's made a proper swing. And if it hasn't made a proper swing, then it's not a valid. There's no point in it being a minor swing. Okay, this was an amazing trade. This is what I mean by a proper swing point. Look at the market. It makes a high here. Again, this is one of those 1 pip closes below. So the market makes a sharp move down, and then it sharply rallies back up there. That's like a really, there's no minimum number of bars, it's just a massive swing. Now if I said to you use a minimum of 8 bars, what would you have done if that had just gone sideways, just drifted slower for 8 bars and hardly gone anywhere in the Asian session and then it pipped it? It wouldn't have been a violent swing. So there's no real way to call it, a certain number of bars. It needs to look like a deep swing. That was particularly beautiful because you've got an unfilled gap. And the market was past its ATR up there because it had gapped up. And so it made a huge move, carried on going. It traded past its ATR on the day. So when it got up there, that was an absolute no-brainer for a short. But you see, I'm not interested really in the smaller swings. So let's give you an example of what I would call a small swing. This here, that there. I wouldn't really, we didn't get one, but I wouldn't trade an SFP of that. It just, to me, that doesn't look big enough. especially when there's no level there. If we extrapolate that to the left, there's no real reason to be even buying in this area. So if it's just a minor little swing point, there's no reason at all. Whereas in this example here, we actually had a decent level. So the fact that the swing wasn't massive is made up for by the fact that you're buying at a generally very, very good area. And we've stitched up the traders that got long off that area. So people that bought this pullback and moved their stops up to the low have now been knocked out. You know, we can see that happening. But on this, it's just a single pullback low. There's no major SR there. That's the kind of exact example where I would say it's not deep enough of a swing. But look, if you want to get good at identifying what swings are decent, what swings aren't, I'm not joking when I say find some of the major technical analysts. There are quite a few out there. Like I said, I don't want to badmouth anyone in the room, but find them and follow them on Twitter. They will call these swing points out for you. You can literally fade them. They will say, when the market breaks such an area, we're looking to go long, and then you look to go short. I mean, that's all those tweets that I was showing you earlier are genuine stuff. It's not me messing around. Those are genuine tweets from big names. And funnily enough, a lot of their trades worked, but it's just the entry which is abysmal. Because again, they're using that standard definition of trend, and it doesn't work in these markets. There's too many stitch-ups going on. Just reading your question now, Ro. Is time frame relevant? Well, look, the funny thing is, I mean, with time frame, I mean, everyone's got to have rules for what they do. And the funny thing is that some traders will say, look, the market is completely liquid. You know, not liquid, but it doesn't stop. You know, we can talk about the close of every hour or the close of every 5 minutes, but that's just our trading platform or our broker breaking the market down into nice little chunks of information that we can digest. Of course, the market doesn't close every 5 minutes and reopen, right? So really, you know, you can say if it breaks below a swing low and it reverses, does it really matter if it closes above that area, etc.? I tend to find that I'm one of these kind of, although I'm a discretionary trader, I quite like rules. So to me, you know, I'll stick a time frame on and it has to close above that area on the time frame I'm watching. But you know, and I can't comment on what you're talking about because I've got no experience with it. But I tend to find if the market is closed above or above a swing low or below a swing high, it makes it very, very, very reliable. I mean, I know people, I'm kidding when I say this, I know people that have got obscene strike rates with this. Looking at deep swing points and using the stop methodology, I'm talking obscene strike rates. So Graham, can I say more on the FTA? Basically, the FTA, I mean, it's kind of outside, which we did a webinar on last month. But the FTA for me is going to be the first obvious point of structural support resistance. So when you trade a swing failure, it will be the first pertinent point that the market is likely to reverse at. If you don't have a pertinent point, then it's going to be a prior swing point again. So for example, if I traded this here, this swing failure bar here, then because I've got no major SR above market, I'm going to basically gun for the highs up here. Because it's not a major FTA. I mean, as we come into these kind of highs around here, we might have a little bit of trouble sort of into this area here, but it's not a major area. You're probably looking at that going to, like I say, the highs. But obviously, if you've got something key in the way, you're going to have to get out there. Or I would get out there, I should say. But it's also, like I say, it's important to know what time frame you're trading it on, because one of the things that you can sometimes do, and this is probably since the webinar's quite close to finishing, it's probably beyond the scope of this, but one of the things that you can do, which is quite interesting, is if you get an hourly swing failure and the market, and you get it fairly late in the session, you could see if your market is going to close as a daily swing failure, because sometimes you can get, if you, let's say for example, let me try and find something here. In fact, let's look at Euro Yen, because Euro Yen did this. I think it was here. Okay, no, it wasn't there. Did this market do it? Was it here? Let's have a look. Yeah, it was here. Okay, fine. So what you could do is remember that it's not just it's just not one time frame specific. If you're trading the Euro Yen, let's say you're looking at the Euro Yen and the market looks like this, what you can see at the moment. So you've got a daily swing high that we know is there. Why is that a swing high? Obviously we've swung away from it. It's quite a nice swing point. So we've got a daily swing high up there at 109.95. Now, if you look at the hourly, you can trade an hourly break close below of that daily high. Now, this is not the best example because this occurred on a Friday and it occurred quite late in the session at 4 p.m. on a Friday. I would never take a trade. But let's say that was like on a Wednesday at 4 or 5 p.m. If we've SFP'd a major daily high and I'm getting short here, there is, especially if it's late in the session, you've got a decent chance that it might turn into a daily SFP. Right? So you're taking an hourly SFP of a daily swing point, and it might form a daily SFP at the end of the day, which means that you'll then have a much bigger target come end of day. Right? You might be short this market, it might start to drift down, and it hasn't really got to your major FTA on the hourly. Let's say your FTA was like here. So you thought to yourself, right, I think it will go there. I'm just picking that randomly. Let's say you thought it would go there, but then you suddenly see a daily swing failure and you're still short, then you might want to revise your target because you've now got the daily pattern indicating it. And I take, you know, I would then switch to the daily time frame to manage the trade, if that makes sense. So I think FTA, sorry, are kind of depend on what time frame you're seeing the pattern on. Basically, Vegas, what I'm looking for is I'm every evening I do a daily, kind of what I call a daily roundup. So every night for me, I look at the market and I look at the swing failure is just one thing I look at, but I look and see if we failed any major swing highs or swing lows. If we failed a major swing high point, let's say the Euro Yen took out this swing point, which it didn't, but let's say it did and it closed below, then I would think to myself, right, I'm going to get short the next day on the hourly time frame. I'm going to choose a daily target because I've seen the pattern on the daily, but I'm going to get in on the hourly and use a stop based on the hourly as well. But I'm going to trade the daily bias. But if I can't see a daily bias, you know, in this Euro Yen there is no daily bias, I'm still going to trade individual hourly SFPs. I'm just going to be in and out a lot quicker because I've got no daily bias. I don't look at volume. No, I don't look at volume at all, actually. So, just to make it clear again, just pull up another example. Okay, so say going back to this this crude oil here, this SFP here, what I'm going to do is I'm going to pull up the ATR 24 period. I'm going to find out what the 24 period ATR is. Okay, and in this case it's 48 ticks. Now I'm going to subtract 48 from the low, not from my entry, not from the close of the bar. I'm going to subtract 48 from the low of that bar. So the bar that I'm getting long at, I'm getting long here, right on this close, but I'm using 48 tick stop beneath that low. So I've got to find out what that low is, which is 104.29, and subtract 48 from it. That's where my stop's going to go. In this case, in oil, I'm riding that to the FTA. Where's the FTA going to be? FTA is going to be here, all these bar lows. Which, incidentally, that was 100 ticks, and it was made in 3 minutes. Fastest result I think anyone's ever had in a trade. But that's neither here nor there. It was news-based. But that's how I'm going to manage it. Simon, I don't go lower. I mean, I just trade dailies and hourlies, and you can get enough setups. To me, personally, I don't think you need anything more. But I don't go lower. But I do know at least 2 traders that have started trading these SFPs and a few months ago and doing very well with them, and they're trading 5-minute time frames with them. Now, I'm not suggesting anyone go out there and start trading the 5-minute, but it works on every time frame. And it's a very, if you're aware of this pattern already, you'll know how good it is. If you're not aware of it, you want to start looking for it and seriously pay some attention to it, because it will completely transform what you're doing. I have no doubt about that whatsoever. But you have to get good at identifying these swing points. So look for the deeper swings. Look for the break below, close above, or a swing high, break above, close below. Try and not to get too excited by big candles that have the big pin bars. You know, you don't want that. You don't really want that. The only criteria you need is break above, close below. 5, 6 ticks below is great. You don't need it to reject it 100 ticks and then pay down there. And once you start seeing this and you start being profitable with it, you'll start to, like I say, when you start seeing these huge pins develop, you'll start almost wishing they wouldn't. Mike, that's a really, really good question. I mean, I'm trading them really, really actively now, and funnily enough, I mean, the thing is that's good about this strategy is it works fantastically in a sideways market, which is where most traders come a cropper. You know, they can do well in a trend, but they can't make any money in a sideways chop fest. And this works so well in a sideways market, it's ridiculous. But one of the markets that I found it does tend to work nicest in is dollar Canadian. And if you look at dollar Canadian on a daily chart, you'll soon see why. But it does work. I mean, it works across all markets, no doubt about it. And I wouldn't say it works. You know, I wouldn't say dollar CAD's the best one. Only trade that. But dollar CAD, it does seem to have a very, very high strike rate on. I mean, there's just stitch ups in that pair, left, right, and centre. And sometimes, I mean, when you start looking at this properly, you will probably be gobsmacked. I don't say I hope it will open your eyes, but there's no hoping about it. I sincerely think if you start looking at this and you start seeing these patterns and recognising them, you'll be gobsmacked by by the opportunities that you're seeing and the number of times they come around, and how traders just fall time and time again for getting in at these areas or stopping out of these areas. But USD CAD does it quite a lot. So JC, the entry is as soon as the bar closes. So whatever swing failure you're trading, it's on the close of that bar. So let me give you one more example. I'll give you they're all over the shop. But I'll give you an example of what I'm looking at here. In fact, incidentally, I'm looking for one. I'm going to be looking for one on the open tonight here in dollar yen. It's a picture perfect. See this level in dollar yen at 81.85s. Got a huge level, prior resistance, and see how the market came back and tested that level, but didn't quite make it. But it made quite a nice little swing point. Now, if we get a swing failure of that low, I would trade that long. because we're trading it basically into a level, but on a break close above that low, I think that would be a very nice opportunity. So you would enter on the close of the bar with a stop below using the ATR. I'm trying to pick an example now to show you. Yeah, I'll follow you in for a second. Let's go to USD CAD. Okay, here's one. Just pull that down slightly. Okay, here's a swing point. Mark the high. There's the swing failure. Okay, when you see that swing failure, hit it at market on the close of that bar. Close of that green bar, it's hit at market. There's no now, if you want to be clever, you know, people say, what about, can I not put a limit order at the prior high, just in case it goes up there, I get an even tighter stop? You know, can I try and sell it at a bit of a better price? Some people even say to me, since we know it often breaks the highs, can I not, if I see that bar, can I not put an order just above the highs for a super tight stop? You know, yes, there's so many ways you can experiment with this. There's a lot of things you can do. But the aim of the webinar is to give you that information, of course, but tell you what I do. I enter on the close of the bar. I'll just literally hammer it straight on the close of that bar there, pull the ATR up, 24 period, oops, I've already got it on there. Okay, hover over the reference bar, and it's 13 pips. So I'm going to look at the high, which is 135, and I'm going to use 13 pips above that, which is 48, which is there. Obviously, I'm going to have to add my spread onto that because my, you know, I've got to factor in my spread to the trade. So my stop's going to go at the red dashed line. Where's my FTA on that market? My FTA is going to be here. Now, I know you're probably thinking, oh, you cheeky bastard, you know, that's exactly where it went to. But look at it. All these highs over here. So, entry on the close of that bar. Let's get rid of the yellow line, it's confusing. Stop at the red, target at the white. If you're not comfortable with the risk reward, don't trade it. Obviously, if you think, well, I've got a 10 pip target and a 50 pip stop, it's a bit illogical to trade it. However, I found that the strike rate with these is very high. And when I say very high, we're talking 90% high. And if you don't believe me, like I say, just go trade, just go start looking at them. But it's, so I will sometimes substitute, because it's got such a high strike rate, I'll take a lower R. Now, not a stupidly low R. I'm not going to do like I say, risk 50 pips to make 10. But I certainly don't need to go for a 2-to-1 or sometimes even a 1-to-1 on these. I'll take a 0.8, a 0.9 if it's good. All right, now I need to call it a night there. I hope you've enjoyed the webinar. And